Good afternoon, ladies and gentlemen. This is an amazing turnout. Don't you guys have anything better to do on a Saturday afternoon? I think, first of all, I'd like to congratulate and to thank David Gerald and CS. I mean, this is a testimony to an amazingly successful educational platform, just an incredible number of turnout here today. So I'm very pleased I have the opportunity to talk about the gold ETF for you today. You've heard a number of speakers already, and I'm sure you know companies like CIMB. I feel obliged to perhaps explain a little bit about who we are. Some of you in the audience may not have heard of State Street Global Advisors. This is what we do. We are a very large financial service company based out of the US. We're actually the second largest fund manager in the world. We manage about $2 trillion US dollars of assets. That's 2 with 12 zeros at the end of it. And we've been managing ETFs in particular since 1993. And again, we have a very large footprint in the ETF business. We have about $300 billion in ETFs. So we're a very large, well-established fund management company. In terms of ETFs, this is some of our interesting things that we've been doing. We actually invented ETFs with the launch of the first ETF in 1993. But in Asia, we've been involved in a number of very interesting and very innovative ETF launches, as you can see from this slide. Now, you're obviously here to hear a little bit about gold. So what I like to do is perhaps give you a picture in terms of the fundamentals of gold. Now, one of the things about gold is that it's a commodity, it's a metal, right? It's not a company that gives dividends where the quality of the management can somehow improve earnings and create earnings growth. It's a commodity, yeah? So really, I think to think about gold, you also need to understand some of the fundamental drivers of the price, which is essentially demand and supply, yeah? So valuation of gold is very difficult because it doesn't have dividends or other inherent earnings. We have to really go back to the basics and think about fundamentals of supply and demand. So with that in mind, this is the total size of the gold market. The above ground stock, i.e. those that are actually available through jewelry and other investments, is about $9 trillion, of which about $3 trillion represents private investments. So investments by central banks, the gold ETF that we manage, and other gold investments that you may have. So gold is actually a very large asset class. So it is a mainstream investment, and that's why central banks invest in gold, and that's why we created the ETF around gold. It's very large, but actually within the context of global financial markets, it's actually quite small. Let me try and illustrate that. When you look at financial markets and compare that with other assets like money markets, bonds, equities, you actually find that gold, despite its large size, actually only represents about 1% of the total allocation. So we actually think that perhaps there's a little bit of an underrepresentation in gold, and investors should really be thinking about gold as a potential asset class for them going forward. So, demand and supply fundamentals. Again, this is really the whole reason why this will drive gold prices. If there are more buyers and sellers, the gold price will go up. If there are more sellers and buyers, the gold price will go down. This chart shows you the evolution of supply and demand over the last 10 years or so. And I'd like to highlight maybe just 3 key features in this pattern. The first key feature, number 1, which you can see up there, is first of all, notice that there's been a huge growth in the supply and the demand of growth. It's now about 4.5 thousand tons compared to about 3.7 thousand tons 10 years ago. The second key feature is the growth of investments. 10 years ago, investments was a very small part of the whole demand for gold. Now it represents about 37% of demand. Yeah? The third key feature is that 10 years ago, central banks, this is the official sector, were net sellers of gold. Now, this year, they've been net purchasers of gold. They've actually been driving the gold price up over in the last few years or so. Now, please bear this in mind because, again, this is a very important, I think, the key driver for understanding the direction of the gold price. So I'd like to drill down into each of these 3 points in turn. In terms of the overall increased demand, where is this coming from? Well, it doesn't take a genius to figure out that when you see the huge affluence over the last 10 years in China, in India, and other places driving demand, a lot of this is coming from China and India. Yep. So you can see that there's been a huge growth in the demand for gold in China, for example. So I illustrate this with China in this example. China has its own domestic production, but still, it's still drawing on the global gold markets as a way to meet their demand. The second key factor was the strong increase in investment demand. So investment demand includes things like gold bars and coins, but also now ETFs. ETFs didn't exist 10 years ago. Now they've begun to be a large part of the total demand for gold. And the third and final factor driving the demand for gold, again, is to do with this idea that central banks are no longer selling gold. In fact, if anything, they are buying gold. This chart shows, the red line shows the limits set under various agreements by central banks in terms of limiting the sales of gold. And there have been 3 agreements so far, the Central Bank Gold Agreement 1, 2, and 3. For the Gold Agreement number 1, between 2000 and 2004, you can see that central banks did manage to stick to that agreement fairly well and did not sell beyond that red line. You can see in the most recent period, 2010, 12, and 14, in fact, central banks, if anything, have not been selling gold, right? They've actually not hit that red line at all. And as the previous picture showed, they've actually been buying gold. If you remember in the CIMB presentation, we saw that Asian central bank reserves were growing very rapidly. They're growing so rapidly that they actually need to put their money at work. And given the current situation with the US, the US fiscal situation and the European debt situation, gold actually is now becoming a very interesting asset class for central banks. And that's why they've now decided to actually go into the gold market and to start purchasing. So we've seen strong demand coupled with limited supply, and that's why we've seen such a strong increase in the gold price over the last 10 years. The one in red is the gold price in US dollars. You can see that it's increased rapidly. It's been quite volatile recently, and I guess one of the issues I'll talk about later is, the role of gold, given that the gold price is so high at the moment. One question that we often get is, well, the Sing dollar relative to US dollar has also been very strong. Does that mean, then, that when I buy gold, do I lose value in Sing dollars? And here you can see that we've shown the gold price actually expressed in Singapore dollars. That's the line in green. And that also shows that the gold price in Sing dollars has also been a very strong driver of returns. So that's the fundamentals of gold. Let me now turn to the SPDR gold share product itself. This is a product that we listed, I think, probably about 3-4 years ago now. Yeah? Okay. I was told it's actually 6 years. It didn't seem as long as that. The design concept behind gold was the gold share ETF was actually very, very simple. What we wanted to do was to create a product that would allow the cheapest and the most effective gold exposure mechanism available to be accessible to the retail investor and to other institutional investors. That asset class is actually gold bullion, And the London markets are the most liquid and the one that's been historically the strongest. So we wanted to allow investors to have exposure to gold bullion in the cheapest form available. And I explained to you during this presentation how we believe we've achieved that. It's now that the SPDR Gold Shares is now the second largest ETF in the world. The biggest is also managed by State Street. It's the SPDR S&P 500 ETF. So it's now become a very important asset class for investors to express the views of the market and to allow investors to actually make efficient asset allocation decisions. So this was listed, first of all, on the New York Stock Exchange in 2004. It was actually the most successful ETF listing ever. We raised about $1 billion after 3 days of trading. So basically the most rapid trading ETF in the world. And as I say, it now it's now the second largest ETF in the world as well, with around $65 billion of assets under management. That's about 40 million ounces of gold that we hold on behalf of the investors of the gold shares. The question we often get is, what are the expenses and how does this actually, how does this ownership compare to other forms of ownership? It says on the top line 40 basis points per year. Let me translate that to English. It's actually 0.4% fees every year. So for every $1,000 that you would invest, there would be about $4 of charges that the manager, trustees, and everyone else would apply to that fund. So that's the total cost of owning gold. It's 0.4%. We apply that charge on a prorated basis every day. And we do this by selling a small quantity of the gold each month. The way this mechanism works is as follows. We hold gold as the asset in the fund to pay for audit fees, management fees, custody fees. We actually need to sell a very small amount of that gold to raise cash to pay for that. Yep. So what you find that over time, the quantity of gold that we have backing each share reduces by this tiny amount, 0.4% every year, which reflects the expenses of the fund. You'll see this later in a chart that we'll show. Okay, now how do we maintain this relationship? When we designed the gold share, we designed it in such a way that one share was worth roughly 1/10 of an ounce of gold. Yep. So let's imagine that we have issued 1 million shares and we have 100,000 ounces of gold in the trust, so held by the trustees, in support of those 1 million shares issued. So one share is worth roughly 1/10 of an ounce of gold. Now, we don't have 1 million shares. We have quite a few more shares than that. As I mentioned earlier, we now own 4 million ounces of gold in the fund. How does the fund actually grow in size? Yeah? Well, it grows in size because we have a panel of authorized participants. So these are investment banks, brokers, and others who are able to create fresh units with us. So in this example, suppose an authorized participant wants to create 100,000 shares of gold shares. What we do is we ask for them to deliver 10,000 ounces of gold, this 1/10 relationship, in order for us to be able to issue those 100,000 shares. So after the creation order, what we have is we have the total number of shares issued is now 1.1 million, so this additional 100,000 shares, but the gold that we have is now 110,000 ounces. The 10,000 ounces was the additional gold delivered by the bank. So this is the mechanism that allows a fund to grow while at the same time maintaining the relationship that one share is worth roughly 1/10 of an ounce. And this is the mechanism that's really created the huge growth and the liquidity in the ETF. This chart shows that this design concept actually works. So the design idea is that each share would be worth roughly 1/10 of an ounce. The gold bullion price is shown in blue on the left-hand scale. Currently, it's about $1,600. The red line is the price of the gold ETF trading on the New York Stock Exchange. That's on the right-hand scale. It's about $160. You can see the blue line and the red line hardly deviates. What you see now, the difference that you see right now, is a result of the expenses that we talked about before, the 0.4% every year. So the design concept works. The design concept also creates quite a lot of activity. This is the pattern of creation and redemption activity that we've seen. And this activity helps fuel the secondary market. The activity of our authorized participants creating shares and redeeming shares creates liquidity in the secondary market. And as you can see, on the Singapore Exchange, we've seen a huge explosion in trading volumes, particularly over the last 2 or 3 years. The average trading volume on the Singapore Exchange is just over $7 million every day, and probably it's one of the more liquid ETFs trading on the Singapore Exchange. Let me talk about another important design concept that we have for gold, which is that the gold held in the trust is actually 100% allocated. I'll explain what that means. The reason why this is very important is really it goes back to the whole reason why you as an investor might be thinking of investing in gold, right? We've talked about the supply and demand fundamentals, but also it's not lost on you that one of the reasons why you think that gold might be interesting is because it offers some form of defense or hedge against very uncertain times, right? And we've seen this over the last 3 or 4 years, just after the Lehman Brothers crash. What you've seen is you've seen equity markets tank, and in response, gold prices have gone up. So one of the reasons why you might want to think about investing in gold shares is simply because as a hedge against your total financial wealth, yeah? As a way to try to mitigate some of the concerns that are out there at the moment. And we still believe that there are a lot of risks in the market. You just need to look at what's happening with the US fiscal discussion, the Eurozone discussion, to know that there are still a lot of stresses in the marketplace. So hedging and using gold as a way to hedge is one of the reasons why you should be thinking about investing in something like gold shares. But here's the thing. If that's the reason why you want to invest in gold, do you actually want to invest in a piece of paper offered by an investment bank promising you to give you good value in a few years' time? I.e., do you want to invest in a synthetic way? The answer is, of course, no. You actually want to be invested directly in the underlying gold, and you want your investment to be backed up by physical gold. So this is the idea behind the custody arrangements that we have for gold. The gold is 100% allocated, okay? The gold is managed and stored in accordance with the London gold bullion rules. The picture that you have there is not a stock picture from a James Bond movie. It's actually a picture of the gold that we own. The reason why we're sure of this is because the gold held by the trust is actually separately identified and put in a separate corner of the vault that we have in London. The vault in London holds all the gold. Every gold bar has a serial number imprinted on it, and that serial number allows us to identify the gold bars that belong to the trust. So this is the idea of allocation. The gold is fully allocated to the trust. What that means in very legal terms is that the trust not only has legal ownership, but physical ownership of the gold as well. If anything happens to the trustee, we can, in theory, go to the vault with our truck and just reclaim all the gold because we can identify each single gold bar that belongs to the trust. So this is the level of security that we think is important, the physicality of owning gold through a very convenient exchange-traded fund. What that means in more concrete terms is that the gold is allocated and we do not lease the gold, i.e. we do not lend out the gold. Yeah? You will recall that part of the issues that came out of the Lehman Brothers bankruptcy was the liquidation of the positions and all the securities lending and all those complicated contracts that arose from that. We're very proud to say that the gold sits there collecting dust and nothing else. We don't lend it out. It doesn't get on-lent to anyone. The gold sits there in physical form as part of the design concept behind the gold ETF. So as part of this bankruptcy, the allocated gold concept allows us to basically take ownership of the property on behalf of the unit holders, because each gold bar is separately identifiable. And we have full rights and titles and physical ownership of the gold. And the fifth aspect is, of course, that we can do this easily because gold is physically separated from other owners who use the same vault as we do. So that, to me, is, I think, the most important aspect of the SPDR gold shares that you should be aware of. We've designed it in such a way that we give physicality. We provide access to the physical gold bullion markets, but in a form, an exchange-traded fund that's very easy and to be able to trade and to hold. The exchange-traded fund trades on the Singapore Exchange, is deposited on the CDP. Therefore, you have the same measure of security as with any other share in terms of your ownership of the shares themselves. But in addition to that, in addition to the fact that it's very easy to access, I think there are other aspects as well. It's very transparent. The gold prices are very are issued throughout the day. So it's a very transparent and very open market. It actually trades 24 hours. It's flexible as well. So you're able to trade this on the Singapore Exchange just like any other share. You can use position limits, open orders, whatever it is that you want to do for any other share. And finally, we believe it's very cost effective. As I mentioned earlier, the price of owning the management fees and the trustee fees and all the other combined fees amounted to 0.4% per year for the gold shares. If you compare that with other forms of ownership that is comparable, i.e. physical ownership, you will run into issues like GST, for example, as a very simple example of some of the additional cost burdens of investing in physical assets in Singapore. Also, we have also included this gold shares in the CPFIS as well, so that if you want to use this as a way to manage your long-term retirement wealth, that's something that can be done through the CPFIS. And again, it's very liquid. You saw the huge growth in trading volumes. It has daily trading volumes of over $7 million per day, which is sufficient for most retail investors. So that really, I think, concludes the core of my presentation. If you want more information, you can find it on this website. It actually contains a lot of very interesting facts and fundamentals about gold. Our partners, the World Gold Council, also have a very extensive website where you can get some data and find some very interesting facts as well. I guess it just remains me to say thank you to the organizers and for hosting today's event. I'm not going to be in a panel, but please, if you have questions, please write them down on the card, and what will happen is that we will reply back to you. So go through the same mechanism, and then CS will make sure that you get an answer to any questions that you may have. Unfortunately, I normally ask for questions during this event, but unfortunately, CS has done such a great job. I don't think logistically it's possible to ask questions from such a large audience. So thank you very much for attending today, and have a good afternoon.